So, you want to own a shopping mall. Shopping malls generated a record $4.8 billion in profit for their largest owner in 2025. The same year, over 1,000 American malls sat empty and abandoned. So what separates the malls printing money from the ones rotting in the sun? I spent months digging into the economics, talking to people who've acquired over $300 million in retail properties, and studying the strategies that are actually working right now. And I'm going to break down exactly what it takes to own a shopping mall. The good, the bad, and the stuff nobody tells you until you've already signed the papers. By the end of this video, you'll understand how mall owners actually make money, why some properties are hidden gold mines while others are money pits, and the single biggest mistake that sinks first-time retail investors. First, let's clear something up. When most people say mall, they picture a massive indoor complex with a food court and anchor department stores. But shopping centers actually exist on a spectrum. You've got enclosed regional malls, the big ones with interior walkways, multiple floors, and major anchors on each end. Then you've got strip centers, open-air properties with storefronts facing a parking lot, and everything in between: neighborhood centers, community centers, power centers, lifestyle centers, outlet malls. Each type has completely different economics. A regional mall might cost $200 million. A small strip center might cost $2 million. The tenants are different. The risks are different. The returns are different. So which one should you actually consider buying? We'll get to that. But first, you need to understand the single most important concept in retail real estate: anchor tenants. If you remember nothing else from this video, remember this. An anchor is the big-name store that draws traffic to a property: a grocery chain, a Target, a Home Depot. They're called anchors because they literally anchor the entire shopping center. Every smaller tenant, the nail salon, the sandwich shop, the phone repair store, benefits from the foot traffic that anchor generates. Here's why this matters for you as a potential owner. The value of your property is directly tied to the strength of your anchors. A shopping center with a thriving Kroger on a 20-year lease is worth far more than the same building with a struggling regional grocery chain on a 3-year lease. And here's the math that might surprise you. Grocery-anchored shopping centers consistently outperform almost every other type of retail property. Why? Because people buy groceries 2 to 3 times per week. That's built-in, repeat traffic regardless of economic conditions. Groceries are also resistant to e-commerce. Despite Amazon's best efforts, online grocery delivery still hasn't cracked the code the way they cracked books and electronics. Now let's talk about how mall owners actually make money, because it's more complicated than just collecting rent checks. The primary revenue stream is base rent. Tenants pay a fixed monthly amount based on their square footage. Simple enough, but here's where it gets interesting. Most retail leases include something called percentage rent. Above a certain sales threshold, the landlord gets a cut of the tenant's revenue, usually between 5 and 8%. So if your tenants are thriving, you participate directly in their success. Then you've got common area maintenance fees, CAM charges. Tenants pay their proportional share of maintaining the parking lot, the landscaping, the security, the lighting, the HVAC in common areas. As an owner, you're essentially passing through these costs to tenants, which protects your margins. But the really savvy mall owners have discovered additional revenue streams that most people never think about. Advertising, those digital screens in the hallways, the banners in the parking lot, the sponsored directories. That's all income. A well-trafficked mall can generate hundreds of thousands per year just from advertising. Events and pop-ups. Temporary tenants pay premium rates for short-term space. A Halloween costume shop might pay $50 per square foot for 2 months. A Christmas kiosk in a high-traffic corridor might pay even more. These pop-ups fill vacant space and create urgency. Parking. Some malls charge for parking directly. Others lease rooftop or lot space to cell tower companies. A single cell tower lease can bring in $30,000 to $50,000 per year for essentially zero effort. And then there's the land itself. Most shopping centers sit on far more land than the buildings actually use. That excess parking lot, smart owners are selling or leasing out parcels to Starbucks, Chick-fil-A, or banks who want standalone buildings with drive-thrus. A single out-parcel ground lease can be worth millions. Let's talk numbers. What does it actually cost to buy a shopping mall? At the low end, a small neighborhood strip center, maybe 10,000 square feet with 5 or 6 tenants, might cost $1.5 to $3 million. These are accessible to individual investors, especially with financing. A mid-sized community center, 50,000 to 100,000 square feet, with a grocery anchor and 15 to 20 tenants, might run $10 to $30 million. You're looking at syndication or partnership territory. A regional enclosed mall, 500,000 square feet or more, with multiple anchors, can cost anywhere from $50 million to $500 million, depending on location and condition. That's institutional investor territory. Pension funds, REITs, private equity, but the purchase price is just the beginning. You need to understand cash flow. The key metric is cap rate, capitalization rate. It's the net operating income divided by the purchase price, expressed as a percentage. If a property generates $500,000 in annual NOI and costs $5 million, that's a 10% cap rate. Retail properties typically trade at cap rates between 6 and 10%, depending on quality and risk. A grocery-anchored center in a strong market might trade at a 6 cap. A struggling enclosed mall in a declining area might trade at a 12 cap, if it trades at all. Here's the rule of thumb. Lower cap rate means lower risk, but lower returns. Higher cap rate means higher risk, but potentially higher returns. The cap rate is essentially pricing in how confident the market is in the future income. Now for the part nobody wants to talk about, the risks. The obvious one is tenant bankruptcy. When a major anchor goes dark, it doesn't just mean lost rent. It triggers co-tenancy clauses. Most retail leases include a provision that says something like, if the anchor tenant closes, smaller tenants can either terminate their lease or demand reduced rent. One anchor failure can cascade into half your tenants walking away or demanding 50% rent cuts. This is exactly what happened to hundreds of malls when Sears and JCPenney collapsed. The anchor went dark, the co-tenancy clauses kicked in, and suddenly, profitable centers became ghost towns. Then there's obsolescence. Consumer habits are shifting. People don't browse like they used to. They research online and buy in-store, or skip the store entirely. Malls designed for 1990s shopping behavior feel dated and irrelevant. The malls that are dying share common traits: too much apparel-focused space, not enough dining and entertainment, poor accessibility, deferred maintenance, and anchors that belong to a previous era. The malls that are thriving have reinvented themselves. They've added experiential tenants, gyms, urgent care clinics, co-working spaces, entertainment venues. They've converted anchor boxes into mixed-use developments with apartments and offices. They've created destinations, not just shopping. So how do you actually get into this business? The entry-level path is a small strip center, $2 to $5 million. Find a property with a strong grocery or necessity-based anchor. Grocery store, dollar store, medical clinic, something recession-resistant, something that drives repeat traffic. Look for value-add opportunities. Maybe the current owner has below-market rents that can be raised at renewal. Maybe there's a vacant space you can lease up. Maybe the property just needs better management and marketing. Finance with a commercial mortgage. You'll typically need 25 to 35% down. Interest rates for retail properties run higher than residential because banks see more risk. Expect to pay 1 to 2 percentage points above residential rates. Build relationships with commercial real estate brokers who specialize in retail. They see deals before they hit the market. They know which owners are motivated. They can tell you which tenants are expanding and looking for space. And critically, understand your market. Study the demographics. What's the population growth trend? What's the median household income? What's the traffic count on the main road? Is there new development coming that will help you or compete with you? Let me tell you about the single biggest mistake I see first-time retail investors make. They buy based on current income without understanding where that income comes from. They see a property throwing off an 8% cap rate and they think they're getting a deal, but they don't look at the lease expiration schedule. They don't notice that the anchor tenant's lease expires in 18 months. They don't realize that Anchor is a struggling regional chain that's closing stores. 18 months later, the anchor is gone. The co-tenancy clauses kick in. Half the tenants demand rent cuts or leave. That 8% cap rate turns into a 3% cap rate, or worse, negative cash flow. Here's what separates successful mall owners from everyone else. They think like operators, not passive investors. They're constantly improving the tenant mix. They're marketing the property. They're hosting events. They're reinvesting in the physical appearance. They treat it like a business, not a bond. They understand that retail real estate is a relationship business. The investors who bought quality assets during downturns and held through cycles built generational wealth. The investors who panic sold at the bottom locked in losses, and they stay humble about what they don't know. They hire experienced property managers. Nobody masters retail real estate alone, so should you own a shopping mall? If you have capital, patience, and willingness to learn a complex business, retail real estate can be extraordinarily rewarding. Grocery-anchored centers in growing markets have generated consistent returns for decades and should continue doing so. If you're looking for passive income with no involvement, this probably isn't for you. Even with professional management, retail properties require decisions, tenant negotiations. The malls that are thriving in 2026 didn't get there by accident. They got there because someone made smart decisions about tenants, reinvestment, and adaptation, and that someone captured the upside. The opportunity is real. Dead malls are being bought for pennies on the dollar, and transformed into mixed-use destinations. Grocery-anchored centers are trading at premium valuations because institutional investors recognize their stability. The bifurcation between winning and losing properties creates opportunities for buyers who understand the difference. The economics of owning a shopping mall are surprisingly compelling. If you buy the right property at the right price, with the right tenants, and manage it like the business it is, the question isn't whether shopping malls can make money. They clearly can. The question is whether you're willing to do the work to understand which ones and why. That's the economics of owning a shopping mall. If you found this valuable, subscribe. I break down the economics of businesses and assets every week.